I talk a lot about option strategies here on my channel, and the reason is simple. They work. If you're buying or selling options or even considering doing so, there's a ton of value in knowing how these different strategies operate and the best time to utilize them. In this video, I'm going to focus on a specific set of strategies called Wingspreads. Now, whether you've heard of this or not, you're going to want to stick around because I guarantee there will be something here you can implement to maximize your results. Thank you for watching this video, but before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. First things first, we need to go over the general strategy behind options trading. This will seem redundant for those veterans out there, but I feel it's important that we establish a foundation before we get into Wingspread specifically. As the name implies, options trading is a financial derivative strategy that involves buying and selling options contracts. Put simply, these contracts give the holder the right, but by no means obligate them to buy or sell an underlying asset at a predetermined price. Options break down into two specific categories, calls and puts. If you're trading, these terms should be pretty familiar to you by now, as they simply separate buying strategies from selling ones. However, there are a few other terms we're going to be using that you'll want to be familiar with. For instance, strike price. This is the fixed price at which the holder of an option can buy or sell the underlying asset when the option is exercised. We also have terms at the money and out of the money. An option is considered at the money when the strike price is approximately equal to the current market price of the underlying asset. An option is considered out of the money when the strike price is not favorable for the holder in terms of making a profit if the option were to be exercised. Okay, now that we have that out of the way, the Wingspread strategy will make a lot more sense. The Wingspread strategy is a bit of an umbrella term, but don't let the mixed metaphor confuse you. What we're looking at here is a specific approach to option strategy built around vertical spreads. These involve the simultaneous purchase and sale of two options of the same type, either both calls or both puts, on the same underlying security with the same expiration date. However, you're going to have different strike prices. The key idea behind vertical spreads is to limit potential losses. If you look at the two main categories, you'll see that one is known as the butterfly and the other is known as the condor. Now at first, these charts appear pretty similar, as they both combine four options with 3 or 4 strike prices. However, as we get deeper into it, you'll start to understand where one Wingspread might be more favorable than another in a given situation. Let's start by exploring butterfly spreads. These combine bull and bear spreads with 3 different strike prices to create a sort of neutral strategy. They can be made up of 4 puts or 4 calls, or a combination of puts and calls, with the latter strategy being known as the iron butterfly. As you can see, the upper and lower strike prices are equal distance from the middle strike price, which we refer to as the at the money strike price. At the same time, all calls will have the same expiration date. There are a few different butterfly spread strategies you can implement. In this example, 1 call is purchased at a lower strike price, 2 calls are sold at a higher strike price, and 1 call is bought with an even higher strike price. We call this a true butterfly because the expiration dates are all the same, as is the distance between the various strike prices. Now let's look at the long put butterfly. In this case, a single put is purchased with the lower strike price. Next we have 2 at the money puts, and finally a put set at a higher strike price. It's important to note that the long call and long put spreads are for when you expect a stock to remain within a certain price range until expiration. You therefore maximize your profits when the stock price stays close to the middle of that range. This is represented by the peak at the center of the chart. Now what happens when you expect a stock to move outside of a price range before expiration? Well, in that case, we have a strategy known, very appropriately, as a reverse butterfly spread. In the first example, we see a short call butterfly spread. You would implement this by selling 1 call at a lower strike price, buying 2 calls with a higher strike price, and then selling another call with an even higher strike price. On the other hand, you have a short put butterfly spread. This is when a trader sells 1 put at a higher strike price, buys 2 puts with a lower strike price, and then sells 1 put with an even lower strike price. Again, the expiration dates are all the same, as are the distances between the strike prices. Remember, Now, butterfly spreads are typically most profitable when the underlying asset doesn't move much before the option expiration date. However, reverse spreads are for situations when you expect the opposite. You'd use these when you anticipate the stock will move outside the price range, but you're unsure of which direction. Okay, let's move on to the other types of wing spreads we'll be discussing today, Condor spreads. As you can see, these are pretty similar to butterfly spreads, but with one notable difference. Condor spreads are built from 4 strike prices instead of 3. This allows them to remain profitable over a longer stock price spread. And because the max profit zone for a condor is much wider, the chart features more of a plateau shape rather than a simple peak. But as with all investing strategies, there is a counterbalance to this benefit. Specifically, condor spreads reduce your maximum profit potential. So if you really want that little bit of extra wiggle room for a stock to move, you have to accept a slightly lower potential return. After all, no strategy can ever be 100% perfect. Otherwise, we'd all be millionaires, right? Let's move on to the types of condor spreads. First, we have the long condor. In this example, you have 4 options, all of which are either calls or puts. So a trader might buy a call at the lowest strike price, sell a call with the second lowest strike price, and sell a call with the second highest strike price, and finally they would finish up the condor by buying a call at the highest strike price. They could also build a condor using a combination of puts and calls, and as with the butterfly, this is known as an iron condor strategy. In this case, the trader would buy one out of the money put at a lower strike price. Next, they would sell one at the money put with the strike price that is much closer to the current price. After that, they would sell one at the money call at the second highest strike price. And finally, you would buy an out of the money call at the highest strike price. Again, much like butterfly spreads, all of the option in your condor spread will have the same expiration date, and most of the strike prices will be evenly distributed. Of course, you also have reverse condors and short condors. Still, those all follow the same strategies as the butterfly counterparts, with the main difference being that condors offer a little bit of price wiggle room at the cost of reducing your profit potential. For instance, a typical reverse condor strategy would involve selling one call at a lower strike price, buying one call with a higher strike price, and then buying another call with an even higher strike price. Finally, you would sell one more call, this time with an even higher strike price. This strategy would be best utilized when you want to profit from a high volatility situation or expect the underlying stock to move dramatically to one side or the other. And remember, it doesn't matter which side the stock moves to, providing it moves outside of the range. Okay, so now that we understand wing spreads a little better, let's talk about how you should implement them. At the end of the day, it doesn't matter if you use butterflies or condors, you're going to get the most bang for your buck in a neutral market with a relatively low volatility. This is where you'll likely see the most profit with the least risk. Now, if you're seeing a lot of volatility, reverse butterflies and reverse condors are probably the better option. However, just remember that the price will need to move outside the range for them to work in your favor. All right, that's the Wingspread strategies in a nutshell. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.